at the design and manufacturing of essential products and technologies that power the cloud and increasingly smart connected world. Intel's deliver computer, networking, and communication platforms to a broad set of customers. Intel is expanding the boundaries of technology through its relentless pursuit of Moore's law and computing breakthroughs that make amazing experiences possible. On 22nd December 2017, Intel has resumed its upward move after a rough November for the chip industry. However, Intel has turned its focus away from the PC market back to the leading edge of modern technology. Revenue growth has shown a sign of life. Thus, over the 3 years, Intel has a revenue growth of 3.95%. Intel transitioned from a shrinking industry to being on the forefront of today's technology has resumed. Intel has a low debt ratio of 0.36, which indicates that the company assets are not fully funded by its borrowed money. It also means that Intel is a less risky prospect for its investment. Besides that, Intel has an operating profit margin of 29.19%, which indicates that the amount of revenue left over. Based on these two indicators, it gives investors a comprehensive view of financial health that it is crucial in making well-informed investment decisions. Intel is potentially exposed to adverse as well as beneficial movements in exchange rates. An increase in the value of dollar could increase the real cost to its customer of its product in the market outside US where they sell in dollars. However, a weakened dollar could increase the cost of expenses such as payroll, utility, tax, and marketing expenses.
Starbucks Corp operates as a roaster, marketer, and retailer of specialty coffee worldwide. The company operates in 4 segments: Americas, China or Asia Pacific, Europe, Middle East, and Africa. It offers coffee and tea beverage, roasted, whole bean and ground coffees, and food and snacks and various food products such as pastry, breakfast sandwiches, and lunch items. The company also licenses its trademarks through licensed stores and grocery and food service accounts. So why do I choose this stock? This is because Starbucks revenue and net income have increased each year. And in terms of technical analysis, the single moving average line 20, SMA 20 is above the SMA 40, which is a good signal for investors. And there is a strong buy signal for Starbucks Corp. Moreover, in terms of stock characteristics, Starbucks have the highest ROE and ROA among all the stocks that are chosen from gainer and losers in both markets. Starbucks has recorded the highest return on equity, which is 50.9, compared to the past 8 years. This indicates that Starbucks can generate profit with each dollar of shareholders' equity. Besides, Starbucks also efficient in managing its assets to generate earnings, which shown in its high return on assets, which is 26.94%. Next, we'll proceed to the risk factor that Starbucks may face. First of all is the market competition. Starbucks already has sizable presence in China, but the company is planning an even bigger expansion. Therefore, Starbucks may face marketplace competition. Besides, due to the company spends an extraordinary amount of money on coffee beans, sugar, milk, and other commodities. Therefore, Starbucks likely exposed to the risk of commodity fluctuation. However, Starbucks uses derivatives contract as a hedge just in case prices skyrocket. And there is evidence to suggest these measures are effective. For example, the cost of green coffee bean futures more than doubled in April 2011 from $1.37 per round to $2.99 per round. Starbucks prices was very affected and continued to grow. Future contracts are only good for a limited amount of time. That's all from me.
Our next stock is Coca-Cola Corporation. The stock code for Coca-Cola Corporation is KO. We choose Coca-Cola Corporation because it is the world's largest non-alcoholic alcoholic beverage company in the world. Furthermore, it falls under consumer sector, which is one of the top 10 sectors that contribute to US economy in 2017. Moreover, the company has the high potential growth since their products are suitable for all people and selling in all over the world. However, the company has some of the risk factors such as changes on market demand and business expansion in emerging markets. The company is facing the risk of changes on market demand since people are debate and concerned about their certain ingredients such as non-nutritive sweeteners used in their beverage products, which has not benefit to people's health. Next, they are also facing the risk in expanding their business in emerging and developing countries because of scarcity for talented employee resources. Besides, they also need to produce the beverage that's suitable or meet with the demand in developing or emerging markets in order to avoid the growth rate decrease and effect to the return on investment.
Another stock that we choose is Constellation Brands. Constellation Brand is a producer and supplier to a broad range of alcoholic beverage including beer, wine, and spirits, currently operating at local market United States and international market at Mexico, New Zealand, Italy, and Canada. This company has market cap of 43.5939 billion. According to the annual report, Constellation Brand demonstrates a rise of 43.13% to reach $9.83 earnings per share in year 2017. Higher EPS indicates higher earnings and strong financial positions. Further, in year 2017, sales rise 11.97% to $7,332 million, whereas return on equity (ROE) increased 22.28%. An increasing ROE indicates that the company is utilizing its fund for business operation effectively. Since Constellation Brand is an older established company, thus it does not have to reinvest most of its earnings for expansion. In this case, this company paid dividend stock at 0.92%, increasing dividend payout ratio from 18.4 to 23.40 means the company is becoming more sustainable. Overall, Constellation Brand shows a bullish trend from year 2012 to 2017, rising 546 times to close at $238.57 per share in the end of year 2017. However, there are few risk factors that associated with the stock's return. Some common risk factors are currency exchange rate fluctuation, unstable government and competitors which will affect financial condition, supply and demand of their products. Not to mention, unfavorable or uncertain laws and policies regarding tax, international trade tariffs will have an adverse effect on their financial results.
Netflix is a steady and potential stock supported by its strong and solid fundamental. It is a large cap company with market cap of 124 billion. Its high PE ratio indicates that investors like the company's prospect for growth and expecting higher earning growth in the future. At the same time, Netflix has high PE ratio too. It indicates that investors have high expectations for the company. Looking into Netflix growth rate, revenue and net income growth significantly. This indicates that the company is very profitable. Looking at the ROE, it increased significantly from 11% in 2013 to 18% in 2017. An increasing ROE suggests that the company is increasing its ability to generate profit without needing much capital. Furthermore, it also indicates how well a company management is deploying the shareholders' capital. Moreover, by looking at the candlestick movement, the stock price trend is in upward directions and making series of new high too. Therefore, it is a great investment as it is safe and profitable for investors. However, marketplace competition is one of the risks faced by Netflix. This is because the internet television business is still very young.
Competition is only getting started in a serious way. Therefore, it is likely that Netflix will face increasing challenges from other service providers. For instance, CBS and other networks are rapidly moving into providing streaming content. In addition, other competing services such as Sling TV and Popcorn Times are also entering the market. Last but not least, there is also Apple TV.